Hey everyone, I'm Brad Gotto, your host of Retirement Redefined, and welcome back to this episode. This isn't exactly a fun and fuzzy conversation to talk about the death of a spouse, but it is a conversation that needs to be had, and it's a conversation we have here a lot at Fiat with families, and it's just one of those deals. We've all been a part of it in some way, shape. We know somebody, or we ourselves have lost a spouse. And it's very common because at the end of the day, if you really stop and think about it, what are the odds that you and your spouse die on the same day? It's just not good. So the vast majority of the time, spouses are dying not only on different days, but different years. And the surviving spouse, the widow or the widower, are left holding the bag. And outside of the emotional side of that, and I don't want to underplay that, but there's also a massive financial impact. And so when we start to think through this as a financial advisor, what are some of the things that we can do ahead of time to kind of set us up for a positive as it can be, at least from a financial perspective, transition for the death of a spouse, but also not just on the numbers side of that equation, but the simplicity side. Because one of the other things that I've seen, I'm in my 20th year in this industry, so unfortunately I've had to go through this more times than I can remember or count, having had clients that have passed away over the years and having dealt with widows and widowers. One of the other things that I just want to address in this episode is the fact that it's not just the numbers, it's the I don't want to call it the inability, but how hard it is to make good, sound decisions when you're grieving. And honestly, it's the last thing almost anybody wants to do, is have to sit there and worry about their finances and the way that they're set up when they're trying to deal with the recent death of a spouse. And so let's dive in and talk about what a widow's tax even is. When you call it a widow's tax, what am I even talking about? And I want to be clear. This is just language we use here at Fiat. If you read every page of the tax code, which I don't recommend, it's like 77,000 pages long, you're not going to see something called the widow's tax. There's not like a separate tax that a widow or widower is going to get hit with, but generally speaking, here's what I'm talking about. If you've got a married couple and both spouse A and spouse B are still alive and they're living a simple, pretty standard retirement, and let's just say hypothetically, I'm going to make numbers up, they're living on $8,000 a month. That's their budget. And however they're comprising that $8,000, let's just say it's a little bit of pension income, a little bit of Social Security, and a little bit of IRA distribution. If that $8,000 a month, that equates to, if you're a math whiz, 8 times 12 months, that's $96,000 a year. That's their lifestyle. And that's what they're spending. If you look at it from a tax perspective, again, to keep things simple, there's nothing else on their 1040 other than a little pension income, Social Security, and IRA distribution. They took the standard deduction at the end of the year. Again, very simple. Their federal tax bill this year, you guys, is going to be about $4,700. Now, that's not the bill at the end of the year. That's the bill they paid throughout the year and kind of the total that's going to be due, right? $4,700 roughly. Now, the problem with that is when you take that exact same scenario, but you remove a spouse. So spouse A dies, passes away, and the surviving spouse, the widow or widower, walks into my office and says basically the same thing that every widow or widower has ever said to me in my time in this industry, and that is, am I going to be okay? And when you think about that question posed to a financial advisor, financial planner, really what they're asking me is financially, am I going to be okay? Do I have enough money? Can I afford to maintain lifestyle? Like, what is this going to look like? If you take that same scenario, let's just assume in my hypothetical scenario, the answer is yeah, they've got plenty of money. That's not the issue. We can recreate the paycheck some way, somehow. Because most people know that at the death of the first spouse, we're going to lose one of the 2 Social Security paychecks. And so we've got to replicate that or replace that somehow. Maybe there isn't 100% survivor benefit on the pension either. So maybe we're going to lose a little bit of that. But the bottom line is, in my hypothetical scenario, just kind of go along with me here, they've got plenty of money to replicate. And the surviving spouse is looking for the same amount of income, $8,000 a month, $96,000 a year. And in my scenario, just to keep things as simple as possible, let's just say that's what we do. So it's the same amount of income. Income is going to be exactly the same at the death of the first spouse. $8,000 a month, $96,000 a year. Where the problems start is the fact that the surviving spouse is not married anymore. So in the year following the death of their spouse, they no longer get to file a married filing joint tax return. They are now filing as a single filer. That same amount of income, $8,000 a month, laid out through pension, Social Security, and increased IRA distributions to make up for the loss of one of the two Social Security benefits, now results in a tax bill of over $10,000 versus the $4,700-ish tax bill they were going to have that they had as a married couple. Same amount of income, $96,000 a year, way different tax bill. How does that happen? Why does that happen? Well, very simply put, the tax code compresses for a single filer. When you think about our tax code, there on the ordinary income tax side, you guys, there are 7 tax brackets. And I don't want to get into the finer details on a podcast because I don't want to bore you to death. And if you're driving down the road and I try to explain every single tax bracket, I'm going to put you to sleep. And that's just not safe if you're listening to this while you're driving. But there are 7 tax brackets, the lowest of which is 10%, the highest of which is 37%. And just as an example, the 10% bracket and getting into the 12% bracket as a married couple, you can have over $100,000 a year come in the door and be in the 12% bracket still. Whereas a single filer at over $100,000 a year, you're in the 22% bracket. So it's a way different deal. The brackets are just smaller, they're compressed. And so that income, although it's the same amount, starts jumping up into much, much higher tax rates. On top of that, you lose some of the standard deduction. As a married couple, it's over $32,000 a year of the income you don't have to pay any tax on. And as a single filer, half of that goes away. So now you're $16,000 of the income that wasn't being taxed before your spouse passed away now is being taxed. So I have more aggressive tax brackets to deal with. I have less write-offs that I get to use from a standard deduction perspective, among some other minor things that I won't get into from a detailed perspective. But the bottom line is you will see an increase. It may not be as dramatic as my hypothetical example of over 100% increase in the tax bill, but I haven't been through this 100 times in my 20 years, but I have been through it more than a dozen times. And if my memory serves, the least increase I've seen in a tax bill of a surviving spouse who's trying to maintain lifestyle or maintain cash flow at the same level prior to the death of their spouse is about a 40% increase in tax bills paid on the same amount of income. And of course, it goes back to the original question that I had, which is, if you are married, what are the odds this is going to happen to you? And the answer is pretty good. Simply because, again, spouses don't tend to die on the same day. And so if that surviving spouse is a widow or widower and still alive for another year, 5 years, 10 years, or maybe sometimes it's much, much longer than that, there's just this massive tax impact that families need to be aware of. That being said, I also want to talk about kind of another side of this, and that is the simplicity side. One of the other big misses I've seen for married couples from a planning perspective, other than dealing with this widow's tax, and I'm going to we're going to end the episode with some solutions. Like, what should I do, Brad, to kind of prepare for this? So just know that that's coming. But I also, before I do that, want to address the fact that it's not just the fact that there's increased tax bills and kind of the potential increased complexity to deal with now that we've lost a spouse. It's the idea or concept that after, and sometimes this is months, sometimes it's years, the surviving spouse is usually, because of the emotional side of losing your partner, in a bit of a fog. And so one of the other big misses I see from a planning perspective isn't dealing with just the cash flow needs and the tax impact and things of that nature at the death of a spouse. It's dealing with the complexity that comes along with it and trying, from a planning perspective, the best that you possibly can to set up your financial plan so that when the first spouse passes away, whichever spouse that is, that the surviving spouse has simplicity on their side. Making sure that there's all the decisions that need to be made, that can be made ahead of time, are made ahead of time. So there's just less to deal with. Because if you're out there and you've lost a spouse, you know exactly what I'm talking about. You're just kind of floating along, trying the best you can to make decisions, and you've got all these decisions to make, dealing with the death of the spouse, the funeral, and the timing of all that and on all these decisions, and you just get to decision fatigue. And then your advisor calls you and says, hey, there's 42 decisions that need to be made in your financial plan based on the death of a spouse. And I'm just here to tell you through personal experience, that usually doesn't go well. And a lot of times can end up in a very negative place because we can't get decisions made in the timely manner that they need to be done, or assets don't flow to the surviving spouse as fast as they need to be able to pay the bills that they need to pay. Or maybe there's opportunity lost as it relates to their investments because we've got too many decisions that weren't made ahead of time, or whatever it may be. But again, the two things that I want to encourage here are understanding the financial impact and understanding the impact as it relates to either the simplicity or, unfortunately, sometimes the complexity that goes along with planning. But let's just kind of tie this episode up in a positive way and talk about what can you do about it. Because again, the odds, if you're a married person, that this is going to happen to you is almost 100%, just because simply there's going to be a gap in date of death between spouse A and spouse B. So let's talk about the financial side really quick. When you think about the fact that taxes just become, generally speaking, more expensive to a surviving spouse, what is something you can do to kind of help alleviate that? Or what are some things you can do to help alleviate that or plan ahead of time? And I'll give you kind of an analogy here to think about. If you were out there and you were going to buy a new house, and if you guys can harken back to 08, 09, before we had the housing crisis, there's a lot of reasons that happened. But one of the things that was kind of a bugger during that time and created a lot of pain and consternation was these adjustable rate mortgages that people were getting into. And so maybe, it had a 5-year fixed rate, but it had an arm, and then after that it would adjust, or it was like had this jumbo provision or whatever it may be. But the bottom line is it wasn't consistent. The mortgage rate wasn't just a 30-year fixed mortgage. And then when things adjusted, a lot of these people that bought these homes couldn't afford them anymore. If you knew, as an example, that was you, and you had one of those mortgages that after 5 years, the rate was going to adjust up, and you knew that, and you were trying to prepare for it. Well, what's one thing you could do to prepare for it? Well, ideally, if you can afford to do it, you try to pay as much of the house off as you can in the first 5 years before it adjusts up, so that you're saving a bunch of this future higher interest rate on a much larger balance. Another thing you could do is you could go out and try to refinance the mortgage and get a different mortgage. But at the end of the day, if you know that it's coming, you try to plan in a way that's most beneficial to you, not most beneficial to the mortgage company, right? We have to think about the IRS that way, because it's the same thing. We know, that any money that you have that you owe taxes on, which is going to be things like your IRA, 401k, 403b, 457 plans, TSPs, any pre-tax type money that you have, money that at some point in your life you put away without paying the tax bill, and that at a future date, you have to pay that tax bill. Well, when should you pay the tax bill? Well, in a lot of cases or scenarios for married couples, the answer is while you're both still alive, because the tax code is just such more advantageous. It's less compressed. You have higher deductions, things of that nature. And so in that instance, one of the things we talk to families about all the time is, hey, look, if you're sitting on piles of IRA money, 401k money, or the like, one of the things you start thinking about is paying off your debt to the IRS, making more than the minimum payment, so to speak, in my mortgage analogy, to get rid of some of that debt while you're both still here, and we have a more advantageous tax return for you, tax situation. So what that would look like practically, let's just say, I'm going to make up numbers. You're a married couple, you're retired, you have $1 million in an IRA, and it's in, the husband's IRA, or it doesn't matter. It's in the wife's IRA. But you have $1 million in an IRA, and you're looking at it and you're like, well, Brad, and you say the same thing to me that most of your peers say to me, which is, I don't really need the money right now, and we're not really going to spend it. And I don't want to pull it out of there because I don't want to pay the tax bill. But then here I come in and I go, okay, I know you don't want to spend it, and I probably can't convince you to take that extra vacation or, to do these other things. And so fine, I'll let you have the fact that you don't need to spend it. But what I do think we should do is we should pay some of that tax bill. You're like, okay, well, why? Why would I pull that money out and pay the tax bill before I have to? Which, if you're unfamiliar, different podcast episode, that's called an RMD. There is a point later in life where they are going to make you start taking that money out. And so you can continue to defer it for now, but eventually you're going to have to pay the piper. And if you don't pay off all the debt before you die, the debt just goes to whoever you give the money to, surviving spouse, kids, or otherwise. So my contention is very simple. We should try to pay off the debt to the IRS, the money that you earned in a past year, past life, when you're working years, You didn't pay off the tax bill when you earned it. You deferred it to today. We could continue to defer it longer, or hear me out, we could start paying it now. Okay, Brad, why would I do that? Well, because you and your spouse are both still alive. I would run you through the same widow's tax scenario that I just ran through and said, if we start paying this off now, we get married filing joint rates, we get married filing joint standard deductions, and because of that, we can start to pay them off today at a lesser rate than if we leave the IRA balance, because you don't need it, so you don't want to spend it, so you leave it in the IRA, then spouse A passes away. Now spouse B has to go through the same exercise, except it's not at the rates you used to pay. It's at higher rates due to compressed tax brackets and less standard deduction, amongst other things. All of a sudden, it starts to come into view. You're like, I'm prepaying my mortgage is what I'm doing. Because all of us out there, I'm one of those people. I have a mortgage, okay? And the deal with the bank, I've got a 30-year fixed rate mortgage. And so I can just make the minimum payment every month for 30 years. And at the end of it, I'm paid off and they've got their interest. It's also possible I could make extra payments. I could pay more than I have to. Well, why would I do that? Because I have to give up cash flow. I have to give up money today. Well, I'm doing it because I know that it saves me money tomorrow. I pay less interest to the bank. The faster I pay them off, the less interest I pay to the bank. And so it behooves me, or is in my best interest long-term, to do that. Short-term, it's actually not, because I have to give up my cash flow. But a lot of you listening probably have done that. You probably have made extra payments to your mortgage over time and tried to pay it off faster. Maybe it's just because you don't like debt. But for a lot of you, it's because you're like, look, I'm going to save a bunch of interest if I can pay this off faster, so that's what I'm going to do. This is the same thing. It's saying, look, I know when the first spouse passes away, my rate is going to adjust up. I don't know how far up, but adjust up significantly. So while we're both still here and the rate adjusts, before the rate adjusts up, let's start removing some of these assets out of this IRA and paying the bill so that the surviving spouse isn't left with the adjustable rate debt to the IRS. We're going to pay it off while we're both still here and let them have tax-free money or taxed less money at my death. It's just a planning opportunity. It's an opportunity for married couples to keep more of their money and give less of it to the IRS. So it's really important to understand that this type of planning, it doesn't make sense for everybody on planet Earth. That's not what I'm saying. I'm not saying every married couple out there should start removing money from their IRAs as fast as possible. What I am saying is you should review your situation and figure out if this makes sense for you. What I'm also saying is the vast majority of the time, this is true, that you should probably be prepaying some of this debt to put it into a situation where it's more advantageous to the surviving spouse. The ancillary benefit, other than if paying the IRS less money isn't enough for you to make a change in your life, also keep in mind you're also creating more simplicity for their surviving spouse to deal with those assets at your death. And anytime you can create simplicity from a planning perspective, I think you're doing the surviving spouse a massive favor. Because while they're grieving the loss of their partner and all the other decisions that need to be made, this is just one less thing that they have to worry about, is dealing with tax debt that is left in a surviving spouse's retirement account. So it's kind of this twofold situation. Now, the other thing that I want to bring up, just because as an ancillary thing to be thinking about from a planning perspective with this widow's tax concept, is it doesn't just affect, when you think about your 1040 in retirement, married or not married, this is true for everybody. The different types of money that you've saved from a tax perspective, not from an investment perspective. I don't mean like, well, I'm reviewing my Apple stock versus my Nvidia stock. That's not what I'm talking about. I'm talking about pre-tax money, the IRA 401k type money, versus after-tax money investments, which could be a physical investment like a rental property. It could be Apple stock you bought in a brokerage account, stuff like that. Or the other bucket is tax-free money, like investments inside of like a Roth IRA or maybe an HSA, okay? When you think about those three buckets of money and the taxes associated with them, they all hit your 1040 differently. The other thing that hits your 1040 differently and kind of has its own line item, there's a reason these all have their own line, because they all mean something a little bit different. And so you kind of have to separate them out on the tax return. The other thing that's going to hit differently is Social Security. It has its own set of rules on how it's taxed. It's called provisional income calculations. Another thing that's going to hit a little bit differently would be dividends, potentially, capital gains, potentially. And so devising how all of this is going to hit your 1040 and understanding the impact of it so that you understand the tax bills and anticipation of bills that you're going to have to pay becomes really important for everybody. But at the death of a spouse, when the tax brackets change because you're now single, when the deductions change because you're now single, it doesn't just affect the tax rate on the IRA, like we've been talking about this entire time. It can also affect the taxes you've been paying on Social Security. So there's like this compounding effect. It could also change the taxes you pay on your after-tax investments and the growth and the capital gains that you deal with. So there could be this cascading effect where it's not just negatively impacting my IRA. It could increase tax bills on Social Security. It could increase your Medicare premiums because Medicare premiums are income adjusted. It's called IRMA or IRMA brackets, income-related brackets. And so if you look at it as an example, as a married couple, you're allowed to have over $200,000 of adjusted gross income, modified technically adjusted gross income. I think it's 209. Don't quote me on that on the podcast, but it's a little over 200 grand. You're allowed to have hit a tax return and still pay just base rates for Medicare, just the standard base rate for Medicare Part A and Part D. If it goes over that threshold, they start to increase your premiums, income adjusted premiums for Medicare. Well, as a single filer, that changes. It's half of that. You can't have a little over 200 grand come in. You can only have a little over 100 grand come in. Well, another thing I see all the time is, although you lost a spouse and you lost their Social Security payment, or one of the two, you get to keep the higher of the two Social Security payments, that doesn't change the income that's coming off the portfolio. If you've got interest income coming in the door, dividend income coming in the door from your investments, you've got pension income coming in the door, that could stay the same depending on how you chose to take that benefit. There's a lot of things that might be coming in the door. And I know this sounds like a first world problem, and that's because it is. And so I want to, just acknowledge that. But I also run into a lot of widows and widowers that have more income coming in the door than they need. All of the sudden, all this portfolio income and investment income and cash flow through Social Security income, things like that, equates to more income than they're probably going to spend, but it's going to hit the 1040 anyway. And now it's a single filer 1040, not a joint filer 1040, and it compounds all the problems that we just got done talking about. And so from a financial planning perspective, here's what I want all of the listeners to understand in this episode, and that is that when you think about kind of the timeline of your life in retirement, we've talked in past episodes about what the tax timeline, and the first real kind of change, the rules of the game change for you is age 55. Kind of the last major change is age 75. And during that 20-year period, the rules to the game and how you interact with different social welfare programs, different taxes, and things of that nature change multiple times between ages 55 and 75. But one of the other things that's going to change is at some point, if you're a married couple, is the death of a spouse, and we're going to have to deal with this widow's tax and all of kind of the butterfly effect of things that are going to happen because of that. And so when you're building your financial plan and you're talking to your financial advisor, if you're not working with Fiat directly, one of the conversations all of you should be having is, hey, can we model out a financial plan of, the first spouse passing away? Can you show me what that looks like, how that changes things, how it changes my tax bills, how it changes complexity, how it changes my cash flow? And is there anything I could and or should be doing today to set our family up for the death of that spouse? I've talked about this on previous episodes, but this is how I want to end this episode as well, because I think it's worth saying over and over and over again. There's a lot of you listening and a lot of you that are partners or clients of families that we serve here at Fiat, where we're constantly trying to kind of preach into your life that making decisions based on how things stand today is not always a good idea. In fact, very rarely is that a good idea. We need to be making decisions on where we're headed and where we're going. And for a lot of you, what that means is dealing with the death of a spouse, potentially in the future. And even more than that, it's dealing with the fact that your money isn't going to die with you. We need to think about your money and the life cycle of your money. And for a lot of you listening, that means that we also need to keep into account not just the death of the first spouse, but the death of the second spouse. And then where does that money go? And is there other things I could and or should be doing as it relates to the passing of my estate? Now, once the second spouse passes away, and this money ends up in the hands of the second generation, kids, grandkids, nieces, nephews, or wherever the money, or could be charity. But when I think about my money in that bigger picture and kind of the life cycle of my money and not just my own personal life cycle, what decisions should I be making or could I be making to put myself in the best situation possible, to be as efficient as possible, or said differently, just pay less tax, pay less fees and expenses, and be able to transfer as much of my hard-earned wealth as I possibly can to my surviving spouse, to my kids, to my family, or to whomever it may be. It starts with something like the widow's tax, but it gets to those bigger questions of how do I plan efficiently to live my life today, but set myself up and my family up for success in the future. And so if you have any other questions as it relates to this concept of the widow's tax, or just kind of this big, broad concept of planning for tomorrow and setting yourself up for these, I would say they're kind of unknowns, but they're not really. It's kind of, again, it's not a fun thought process to have, but we all know that eventually we're going to pass away. And for a lot of us listening, you might be the surviving spouse. You might be the one left holding the bag. And what can I be doing, or what should I be doing? And I think about that as a husband. With my wife and I, the odds are unfavored. I'm a little bit older than her, not a lot. She would want to make sure that I understand. I tell everybody, yes, I always tell her I'm the older one, I'm more wise, but it's by like 5 months. But I'm a guy. So if we just play out the odds, I'm going to predecease her, like in the perfectly average. And so one of the things I think about is the person who's probably going to die first, if again, we're just the average couple, is I want to leave my wife in the best place I possibly can. So whether you're thinking about it from the perspective of I'm the one that's gone and I want to make sure my family is taken care of, or you're thinking about it from the perspective of I'm the one that's still here and I'm the one that's lost the spouse, what can I be doing to make sure that my family is set up for success? It starts with conversations like this, and it starts with concepts like the widow's tax. So again, if you have any other questions at all, feel free to reach out to us here at Fiat. If you're a family working with Fiat already, I would encourage you to reach out to your advisor directly. If you're not working with us directly, you can reach us at in fact, you can just go to our website. Everything you need to know is on the website. Our contact information is on the website. It's Fiat, FIATWM.com. Thanks for joining us for this episode of Retirement Redefined. As always, you guys, I'm your host, Brad Gotto. Thanks for joining us. If you've not yet subscribed to the podcast, I would encourage you to do so you get notified when new episodes come out. Feel free, if you want, to tell your friends and family members about our podcast. And as always, I hope you learned something today. We will see all of you on the next episode.